Something just changed in XRP that matters more than it looks. Because this isn't about today's price action. It's about whether XRP is beginning to connect to parts of the global financial system measured in the hundreds of trillions of dollars. At a time when institutions are actively exploring tokenization, settlement, modernization, and liquidity efficiency. In this video, we're breaking down the number behind the XRP thesis, the significance of Ripple's growing institutional connections, the role of tokenized assets, and why some analysts believe even small levels of adoption could have outsized implications. By the end, you'll understand exactly where the bullish projections come from and where the assumptions begin. Let's start with the number driving this entire conversation. 100 billion. That's the maximum supply of XRP. Now compare that to the market supporters believe XRP could eventually interact with. Cross-border payments, tokenized assets, institutional settlement flows. Some estimates place the total addressable opportunity at more than 500 trillion annually. That's massive. Let that number sink in. Whether those numbers are realistic is open to debate, but the arithmetic behind that thesis is surprisingly simple. And that's why the discussion has become so important. Because if even a small fraction of massive settlement activity were to require access to a fixed supply asset, the economics begin to look very different. Now, this is what most people miss. The XRP argument is not primarily about retail investors buying tokens. It's about infrastructure. It's about settlement. And it's about whether financial institutions eventually choose to move value across digital rails instead of traditional systems. If you want the satellite perspective on XRP and the crypto market and want to step back from the daily chaos and noise, make sure you subscribe and join the channel. I break things down in a simple way so you can actually understand what's really happening in the market. The question most investors are asking themselves. Most discussions around XRP focus on price. Will it go higher? Will it reach previous highs? Can it compete with other crypto assets? But institutional investors often start from a different perspective. They don't begin with price. They begin with infrastructure. Because throughout financial history, infrastructure has often become more valuable than the products built on top of it. And that's where this discussion becomes interesting. The core thesis isn't that XRP becomes the world's most popular cryptocurrency. The thesis is that XRP could become part of the settlement infrastructure supporting massive financial activity. And those are very different ideas. Now, this is what most people miss. The conversation isn't about how many people buy XRP. It's about how much value potentially moves through systems connected to XRP. That's the distinction. Zooming out, let's talk about the scale of global finance. See, to understand the argument, we first need to understand scale. Global financial markets operate in numbers that are almost impossible to visualize. Cross-border payment activity reaches into the hundreds of trillions annually. The derivatives market is measured in the hundreds of trillions. Tokenized assets are projected by institutions and some analysts to reach multi-trillion-dollar levels over the coming decade. And when people discuss XRP's future role, they're looking at these markets, not retail crypto trading, not meme coin speculation, the infrastructure layer, the settlement layer, the liquidity layer, short-term noise, long-term structure. That's the framework. Think of the Medici banking network. See, to understand why settlement infrastructure matters, consider a real historical example. See, during the Renaissance, the Medici banking network transformed European commerce. Merchants didn't move physical gold across every transaction. Instead, trusted banking relationships and settlement systems emerged. The institutions facilitating movement of value became increasingly important. The lesson wasn't that gold disappeared. The lesson was that efficient settlement became a competitive advantage. Today, many analysts believe digital asset infrastructure could replace a similar evolution. Different technology, but same economic objective. Move value more efficiently. See XRP's fixed supply and why it matters. At the center of the XRP discussion sits one important number, 100 billion. That's the maximum XRP supply. Unlike fiat currencies, which can expand, unlike many financial assets that can be issued continuously, the XRP supply is fixed. Supporters argue that if settlement demand grows significantly while supply remains fixed, price pressure could emerge. Critics counter that transaction volume alone does not automatically translate into asset value. Let that sink in, ladies and gentlemen. See, perspective matters because volume and valuation are not the same thing. You have to understand this. They both matter. But here's where it gets interesting. See, even critics generally acknowledge that if a settlement asset becomes widely required, demand characteristics can change dramatically. And that's where the arithmetic begins. See, tokenization is the biggest story, ladies and gentlemen. Much of crypto discussions revolve around payments. Yet many institutions are increasingly focused on tokenization. The tokenization thesis is simple. Real-world assets become digital. Stocks, bonds, real estate, funds, private credit, and eventually assets we may not even be discussing today. Several projections suggest tokenized asset markets could reach tens of trillions of dollars over time. But tokenization itself isn't the end goal. It's merely the foundation. The bigger the opportunity comes from what happens after assets become programmable. Write that down. When digital assets can interact with other digital assets, when financial products can be built like software, when settlement becomes instantaneous, that's where the concept of composability enters the picture. What that means in English, we'll take the PhD at our PhD. Think of financial assets as Lego blocks. A bond becomes tokenized. A real estate asset becomes tokenized. A money market fund becomes tokenized. Now, those assets can potentially interact in entirely new ways. New lending protocols, new lending products, new collateral systems, new liquidity pools, new market structures, products that literally don't exist today. That's why some industry leaders describe tokenization as the only first phase. The real transformation comes after, when assets become interoperable. And every one of those interactions requires settlement. That's the key point. The BIS projection. Let's examine one of the numbers frequently cited in XRP discussions, all right? The Bank of International Settlements has been among institutions studying tokenized finance and future market structures. One commonly referenced estimate suggests tokenized asset markets could reach around 16 trillion by 2030. Now let's apply a simple turnover assumption. If those assets change hands twice annually, that would create approximately 32 trillion in yearly settlement activity. Not valuation, settlement activity. Those are two different things. And that's important because settlement demand is what XRP advocates focus on. See, this is the first valuation model, ladies and gentlemen. Write this down. Let's run the arithmetic exactly as supporters often present it, okay? Tokenized asset settlement volume, 32 trillion annually. Assumed XRP settlement share, 1%. That equals 320 billion. Now divide that by the maximum XRP supply, 100 billion coins. The result, $3.20 per coin. Again, this isn't a prediction. It's a simplified model. But it demonstrates the logic supporters use when evaluating adoption scenarios. See, imagine the early railroad networks of the 19th century. The most valuable opportunity wasn't always the cargo. Sometimes it was owning the rails themselves. XRP proponents argue that settlement infrastructure could function similarly. Not every asset needs to be XRP. Not every payment needs to be XRP. But if XRP becomes one of the rails connecting financial activity, demand dynamics could change significantly. Whether that happens remains the key debate. Let's talk about SWIFT for a second. Now we arrive at the development attracting enormous attention. SWIFT. See, for decades, SWIFT has served as the dominant global financial messaging network. Banks send payment instructions through SWIFT, but SWIFT itself generally doesn't perform settlement. Instead, banks often rely on correspondent banking relationships. This creates a system dependent on pre-funded accounts known as nostro and vostro accounts. Capital sits idle. Liquidity becomes trapped. Settlement becomes slower, expensive, and operationally complex. For years, Ripple has argued that digital assets and settlement could reduce those inefficiencies. See why the SWIFT discussion matters, ladies and gentlemen. The significance isn't really messaging, it's liquidity. Supporters believe that if Ripple-connected infrastructure gains meaningful institutional adoption, well, XRP could potentially serve as a bridge asset between currencies. The argument is straightforward, but rather than maintaining large pools of dormant capital around the world, institutions could access liquidity when needed. Again, this remains an adoption thesis, not a certainty. But it explains why institutional connectivity receives so much attention, because infrastructure changes can create structural demand. So let's talk about the 150 trillion number for a second. A frequently cited figure in XRP analysis is approximately 150 trillion in annual cross-border payment messaging volume associated with SWIFT. Okay? Let that sink in for a second. Stay with me here. Let's apply the same exercise now. Assume 1% settlement share. That equals 1.5 trillion. Add the earlier tokenization estimate, 320 billion, combined 1.82 trillion. Now divide by 100 billion XRP. The arithmetic produces $18.20 per XRP. Again, not a forecast, a scenario model. Nothing more, nothing less. Regulation changes everything, ladies and gentlemen. Now, this is what most people miss. Technology alone rarely transforms financial infrastructure. Regulation matters. Institutions move cautiously. Compliance departments matter. Legality, clarity matters. And legal clarity matters as well. Risk committees matter. Throughout Ripple's legal battles, one question dominated. What exactly is XRP from a regulatory perspective? The answer has enormous implications because institutions generally prefer certainty before deploying capital. Ask any compliance and AML officer. Believe me. And over the last several years, regulatory developments have become a major part of the XRP narrative. I want you to think of the creation of FedWire, okay? A second historical example helps illustrate this point. When the Federal Reserve expanded electronic payment infrastructure through systems like FedWire, settlement efficiency increased dramatically. The technology mattered, but the real catalyst was institutional trust and regulatory acceptance. Markets adopt settlements and systems they trust, not simply systems that are technology superior. That's a lesson repeated throughout financial history. Now, the $514 trillion thesis. Now we reach the most ambitious model, ladies and gentlemen. Everyone's been waiting for this. Some XRP researchers combine multiple market segments, cross-border payments, tokenized assets, derivatives, institutional settlement activity. The result is an estimated addressable market approaching $514 trillion. Massive. That's an enormous number. The assumption is not that XRP captures all of it. The exercise asks a different question. What happens if XRP captures a small percentage? At 1%, approximately 5.14 trillion, divided by 100 billion XRP, roughly $51.40 per coin. At 10%, the arithmetic approaches 514 per coin. Those numbers drive much of the excitement surrounding XRP, ladies and gentlemen. But there's an important caveat. Volume does not automatically equal market capitalization. This is crucial. A dollar can move multiple times. Liquidity velocity matters. Market structure matters. Collateral requirements matter. Institutional behavior matters. Many variables influence valuation. So while these calculations are useful frameworks, they are not guarantees. They are scenarios. Investors should understand the distinction clearly. Think of the internet in the late 1990s, ladies and gentlemen. Most people focused on websites. Few focused on the underlying protocols enabling communication. The websites changed constantly. The protocols endured. See, some XRP supporters view settlement infrastructure similarly. Applications may come and go. Financial products may evolve. But the settlement layer could potentially become increasingly important over time. Whether XRP achieves that role remains uncertain. But that's the comparison often made. Let's talk about something that makes this discussion fascinating, is that many projections don't even include future innovation. No, that's difficult to quantify. History shows transformative infrastructure often enables products nobody can anticipate. The internet created social media. Smartphones created app economies. Cloud computing created software ecosystems. Could tokenized finance produce similar purposes and surprises? Possibly. That's why many analysts focus on composability, because the most valuable application may not exist yet. So let's talk about short-term noise versus long-term structure. You know that. I always tell you to pay attention to what's quiet. Markets often focus on headlines, price movements, daily volatility, social media debates. But institutional infrastructure evolves over years, sometimes decades. That's why one phrase remains important: short-term noise, long-term structure. Prices reacting, systems evolving. Those two realities can coexist. Pay attention to what's quiet, ladies and gentlemen. So what investors should watch? This is not financial advice, just my own opinion, and it retains myself and our organization in any capacity. Moving forward, several developments deserve attention. Institutional adoption metrics, settlement volume growth, tokenization initiatives, cross-border payment integrations, liquidity usage, regulatory developments, and most importantly, actual usage, because real-world demands ultimately matter more than theoretical demand. Write that down. Always. See, the XRP debate ultimately comes down to one question. Can a fixed supply digital asset become part of the settlement infrastructure supporting a rapidly digitalizing financial system? Supporters believe the opportunity spans cross-border payments, tokenized assets, institutional settlement, and future financial products. Skeptics argue adoption remains uncertain and valuation models may overestimate demand. Both viewpoints deserve consideration, always. What cannot be ignored is the scale of markets involved. Trillions of dollars, institutional infrastructure, global settlement networks, and a financial system increasingly moving towards digital rails. Whether XRP captures a small share or a significant share remains unknown. But the arithmetic behind the thesis explains why so many investors continue paying attention. Because when demand is measured in trillions and supply is measured in billions, even small changes can produce very large outcomes. If you found this breakdown valuable, subscribe to the channel for more deep dives into macroeconomics, institutional finance, crypto infrastructure, and the structural shifts reshaping global markets. And let me know in the comments, what percentage of global settlement volume do you think digital assets will capture over the next decade? Because the answer to that question may determine far more than the future of XRP. It may help define the future of finance itself, ladies and gentlemen. Hope everyone's having a fantastic Friday. Markets are closed for holiday, but the interpretations never do. I want to welcome all the new members of the Patreon, the Crypto Republic Desk Monthly, all the new members of the membership channel. Remember, we're having our first Zoom call tomorrow at 2 o'clock for all the members of the Crypto Republic Desk Monthly inside the Patreon. The code and link and access password has been sent out to everybody. See, what I'm paying attention to right now, and I've been spending all day talking to clients, sovereigns, families, and family offices on the phone this afternoon, is the perception of the market will now be moved by the 10-year and the DXY. The market's going to perceive, will the Fed, new chairman, raise rates, or will he lower rates, or will he keep them the same? When it digests the outcome to those three different scenarios, that is the determination of where the market's going to go. Yeah, there's a lot of noise coming out right now of the ME about, they're shutting the strait, they're opening the strait, blah, 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 blah. Remember, being remoras, we feast on the sushi. We don't get cut up by the sushi. We don't FOMO. We don't chase, okay? We don't do that. Ladies and gentlemen, if you're looking to learn how to trade, if you want to learn how to invest, come and join the Crypto Public Desk Monthly. One good tip from the pits can pay for your entire year subscription, okay? Come and join almost 600 active traders, investors. Doesn't matter where you're at with your journey. Learn how to trade and invest at the same time. So if you're looking for deeper macro research and learn how to take advantage of all the things we discuss and go over, come and join the Crypto Public Desk Monthly, ladies and gentlemen. See, we go over a lot of things here because as financial mercenaries, there's always something to take advantage of. There really, really is. The shortages created from the lack of oil and resources coming out of the strait is going to create trading opportunities for the next 36 to 60 months, as far as we're concerned, that will be able to be taken advantage of tactically from actual deficits. These range from metals, food products, plastics, everything. So this will stretch the whole gamut, the actual commodities, futures, stocks, money. I tell you all the time, we're short-term bearish on metals. We're long-term bullish. Not financial advice. here's a good place that I am purchasing physical for the long run. We went over in the previous video that XRP is being hoarded by certain wallets now. I am comparing this to what happens in the mining and refining industry, where you have dominant players just gobbling up all of the land. You see this in metals too. We see there's a lot of action happening in aluminum right now. There's a lot of things going on that people just don't pay attention to. They just don't. See, the Middle Eastern supply of aluminum, that collapsed. But I want you to understand something right now, right? We believe the Harry Houdini freak show is about to have another chapter. And it's the people that pay attention to this. They don't get cut up like sushi. They prosper from this. You have to look at this overall, right? You really, really do. And I look at this overall. If you make it to this point in the video, why don't you like the video and subscribe? Because the rants is where we really go over a lot of things. But I want you to understand something, okay? Nobody is talking about aluminum, and there's three massive problems that nobody's talking about. You see, over the last few months, at least for myself and our organization, we have been very bullish on aluminum. See, Middle Eastern supply collapsed, physical markets tightened, premiums exploded, inventories fell, ladies and gentlemen. And for a while, the trade looked incredibly straightforward. Less supply, higher prices. It's simple. We're seeing that with a lot of things, okay? Except markets have a nasty habit of punishing consensus. They do. Right now, aluminum is facing three major headwinds that are very nasty and few people seem to be paying attention to. In fact, these trends continue over the next several months. Aluminum could experience a surprisingly sharp correction before eventually moving much higher. So I want you to pay attention to that the same way that we're looking at chocolate, cocoa. That may go through a major support. See, people don't pay attention to these things. They pay attention to only what's on the TV or they hear on the radio. When you pay attention to all the financial products and instruments, there's always a delicious trade to be found. Always delicious to be had. See, I like looking at inventory data. I like looking at trade flows. I like looking at production data. I like looking at positioning. And most importantly, when you look at numbers, it can completely change stories of something. If you look at the numbers about aluminum, it's crazy. So, for me, aluminum rallied in the first place because the Middle East accounts for roughly 10% of global aluminum production. Now, you might be asking why I'm talking about aluminum right here, right now, because this is part of the AI race and war. It's a very, very big situation because aluminum production across major producers, including Bahrain, Qatar, the UAE, and Iran, collapsed. So if you look at industry data, Middle Eastern production fell approximately 35% year over year. That's massive, ladies and gentlemen. It's an enormous disruption. So if you take this into context, aluminum is not a market where you can simply flip a switch and create supply overnight. You can't do that. Smelters are extremely energy intensive. Production interruptions matter. And that's exactly why physical markets tighten so aggressively again. See, I pay attention to these factoids that most people don't pay attention to. And that's why to us, it's like mapping out where we go and why. So you look at European buyers, they started competing with American buyers. Regional premiums surged. LME inventories continued falling. Time spreads moved into severe backwardation. That's so telling. So these are all classic signs of a market becoming physically tight. And if that were the entire story, as far as I'm concerned, aluminum would probably be heading much higher right now. But it's not. It's not. Because while everyone's looking at one side of the market, the other side is quietly changing, ladies and gentlemen. China is producing more aluminum than people think, and this is massive. This has changed all the trade with this. This is where things get interesting. See, most analysts are using Chinese aluminum production estimates around 45 to 46 million tons annualized. But according to Bank of America, they're using 46 million tons in its base case. At that level, the global market remains in a small deficit, around 150,000 tons. You're writing this down, you're so far ahead because a lot of these plays, the mathematics matter. That's the one beautiful thing about futures and commodities. The math matters. This sounds bullish. The problem, Chinese government data tells a very different story, ladies and gentlemen. So according to official figures, Annualized Chinese production reached approximately 47.6 million tons in April. 47.6 million tons in April, okay? That's nearly 2 million tons higher than some industry estimates. Think about what I just said. And in a market expected to be barely in deficit, an extra 2 million tons changes everything. So instead of a shortage, you suddenly have a surplus. And that's why this production debate matters so much. See, the difference between bullish and bearish aluminum right now may literally come down to whether China's real production is 45 million tons or closer to 48 million tons. I mean, you're talking about a country where sometimes you got to pay attention to the actual electricity bills to see what's really going on. Are their factories running or not? See, I learned not to pay attention to anything that comes out of China. I look at figures to see if actual factories are working or not. This is not a small discrepancy. That is the entire market. So when you look at this, it's crazy. But if you look at the inventory story, that's something even different, because that's misunderstanding the risk in the market. See, during the disruption in the Strait, logistics became increasingly difficult. So metal kept being produced, but shipping became more complicated, which means inventories likely accumulated throughout parts of the Middle East. So think about what happens if geopolitical tensions begin easing right now, right? Someone blows a whistle, time out, no mas, no more fighting, kumbaya, right? Suddenly those inventories can move now. What do you think is going to happen? Suddenly the material that was effectively trapped enters the market. An estimate suggests between 500,000 and 1 million tons could potentially become available. 500,000 to 1 million tons. Think about this. That's not a trivial number. That's enough metal to materially change physical balances. And here's the problem. See, this is probably boring to a lot of people, like watching paint dry on the wall. But I get so excited about this because these are opportunities to prosper and profit. Most people don't pay attention to this. They're watching sports. The only sports I watch is financial combat. Ladies and gentlemen, if you want to learn how to take advantage of what I'm going over right now, come and join the Crypto Public Desk Monthly. One tip from the pits can easily pay for your entire year subscription. I outlay the situations that we're following right here, but inside we go over price points, levels, everything about how we do this. And it doesn't matter if you're just starting out or not. Again, but here's the problem. Markets are currently pricing scarcity, not abundance. So if hidden inventories begin flowing into Europe and Asia, some of the extreme tightness we're seeing today could disappear surprisingly quickly. That doesn't mean that long-term bull case dies, but it does mean the short-term setup becomes much more dangerous. So you got to understand something. Now, this is something that people are not paying attention to. Indonesia is becoming a serious player, ladies and gentlemen. See, we watch everything because all of our offices for platinum plating, refining, and mining are in Indonesia spread out. So we've been watching what goes on over there in the metals market forever, the better part of 2.5 decades. This is probably the least appreciated story in the aluminum right now. Everybody watches China. Everybody watches the Middle East. Almost nobody watches Indonesia unless you're talking about Bali or something like that. Again, you should be paying attention because Indonesia produced approximately 600,000 tons of aluminum last year. Okay. This year, production could exceed 2.2 million tons. So if production could increase by roughly 1.6 million tons in a single year, that's a massive expansion, ladies and gentlemen. Exports are already rising. Shipment data is already trending higher. New smelters continue ramping. And unlike many Western producers, Indonesia is aggressively pursuing downstream metal production. The market knows this supply is coming. But I don't think that the market fully appreciates the scale yet. Because if China overproduces at the same time Indonesia ramps up faster than expected, suddenly the global aluminum balance looks very different, ladies and gentlemen. So this is why, in my opinion, the market's very confused, really, really confused. And it's fascinating is that the physical market and the macro market are sending completely different signals. Physical markets are screaming tightness. Premiums are elevated. Inventories remain low. Backwardation persists. Yet futures markets have started showing cracks. Why? Because traders are beginning to focus on future supply rather than current shortages. The market isn't asking, how tight is aluminum today? The market is asking, how tight will aluminum be 6 months from now? Those are very different questions. And that's why prices have started struggling despite generally strong fundamentals. So the demand side is starting to matter as far as I'm concerned. So if you look at demand, and again, most people think that this is like watching paint dry on the wall. I get excited about this because this is where it gets even more complicated about demand. Manufacturing PMIs remain relatively resilient. On the surface, economic activity still looks okay. But when you actually read what manufacturers are saying, the tone changes dramatically. Companies are reporting rising transportation costs, rising energy costs, increasing supply chain uncertainty, and declining willingness among customers to commit to long-term spending. That's important because aluminum doesn't just need supply discipline, ladies and gentlemen. It also needs demand confidence, and confidence is becoming harder to find. The longer geopolitical disruptions persist, the greater the risk that energy prices begin creating demand destruction across industrial sectors. This is especially important because aluminum demand is heavily tied to manufacturing activity, construction, transportation, infrastructure spending. If those sectors slow down, consumption growth slows with them. That's a big thing. So no one's understanding that a new play is coming in. That's massive. If you look at that, that changes everything. So why am I so bullish long term? Here's why. And this is where things get interesting. Because after everything we've just gone over right here, and I've just said to you, and if you wrote these numbers down, I still think the long-term picture remains very constructive because the structural drivers haven't disappeared. Energy infrastructure investment is accelerating globally. Grid modernization is accelerating. Electrification is accelerating. Transmission build-out is accelerating. And aluminum remains one of the most important metals involved in all of those trends, ladies and gentlemen. At the same time, the industry still faces meaningful supply constraints outside of China. New smelters are very expensive. Energy costs remain elevated. Environmental restrictions remain significant. And capacity growth outside a handful of countries remains challenging. So while the next several months may be vulnerable, the bigger picture still points towards tighter markets over time. That's why some forecasts continue targeting aluminum prices near $4,000 per ton. Okay? Not because today's market's perfect, but because long-term supply-demand equation remains supportive. That's very, very important, ladies and gentlemen. So the real question is no longer whether aluminum is bullish. The question is timing. Does China keep producing at elevated rates? Do Middle Eastern inventories return? Does Indonesia's supply ramp faster? Do energy shortages start impacting global growth? These are the variables that matter the most. Because if even 2 or 3 of these factors move in the wrong direction simultaneously, aluminum could experience a meaningful correction. But if supply growth disappoints and demand remains resilient, the market could quickly find itself facing another deficit. That's why this is one of the most fascinating commodity markets in the world right now, ladies and gentlemen. The story isn't simple anymore as far as we're concerned. And the best opportunities usually appear when the story stops being simple, ladies and gentlemen. It's not financial advice. It's my own opinion. It retains any capacity. I love you all, ladies and gentlemen. For everybody in the Crypto Public Desk Monthly, I will see you tomorrow at 2 o'clock on our Zoom call with Domenico and potentially AJ. Don't get caught up like sushi. Don't FOMO things. Understand that the death by 1,000 tweets is still in play. Look for the low-hanging fruit. Look for the abnormalities in numbers, like the situations I just went over. And if you want to learn how to trade, ladies and gentlemen, and you want to learn how to invest, come and join the Crypto Public Desk Monthly, ladies and gentlemen. I love you all. This information is for entertainment, educational, and informational purposes only. This is not financial advice. Always do your own research. Consult a licensed financial advisor. Never invest based solely on YouTube videos. I love you all. I'll see you on the front lines, ladies and gentlemen.